Have you ever earned money in more than one country and had that nagging thought, am I going to get taxed on this twice? Well, in this explainer, we are going to break down exactly how Bangladesh's tax system is designed to stop that from ever happening.
So, let's say you do. Maybe you're a freelancer with clients all over the world, or you work for a company with international offices. If that's you, then you've definitely thought about what this means for your taxes.
And you've come to the right place. We're about to walk through the entire system that's in place to prevent you from being taxed in two different countries for the exact same income. It's a whole framework that's really built around one simple idea: fairness.
So here's our roadmap. First, we'll tackle the problem itself. Then, we'll look at the handshake agreements governments make to fix it. After that, we get practical, how you get your tax relief, the nitty-gritty of claiming it, and, what to do if things go wrong.
All right, first things first, let's actually define what we're talking about here, this fundamental issue of double taxation.
It really is this simple. Getting taxed twice is like paying an entry fee to run a race, and then, just as you cross the finish line, someone asks you to pay again. It just feels completely unfair, right? Because you're being charged 2 times for one single thing, your hard-earned cash.
Totally. And guess what? Governments know this. It's bad for business, it discourages people from working internationally. And that is exactly why this whole legal framework exists in the first place, to make sure there's a fair and predictable system for anyone working on a global scale. So how do countries actually fix this? They do it with official tax agreements. You can think of them as a literal handshake between governments agreeing to play by the same rulebook.
What's really fascinating here is that these agreements do so much more than just stop double taxation. They're these massive tools designed to prevent tax evasion by sharing information, helping each other collect what's owed, and at the end of the day, just making it easier for everybody to do business across borders. So, what it all boils down to is creating a level playing field. These agreements make it crystal clear who has the right to tax what income, which means you don't get hit with an unfair bill. It's all about cooperation.
Okay, so we get why these agreements are a thing. But how do they actually help you, the person paying the taxes? Let's dive into the mechanics.
The single most important tool is something called the foreign tax credit. Now, this isn't just a deduction from your income. No. It's a direct one-for-one reduction of your final tax bill in Bangladesh. It's basically credit for the tax you have already paid somewhere else on that same income.
And this is where we hit a fork in the road. If Bangladesh has one of those official agreements with the other country, you get that direct foreign tax credit. Simple. If there's no agreement, well, you can still get relief, but it's a big difference. It's a deduction calculated using whichever of the two countries' tax rates is lower. So as you can see, having that official handshake in place makes things a lot cleaner.
Now, there are a few key conditions to keep in mind. First, you have to be a resident of Bangladesh for that tax year. Pretty straightforward. Second, the credit you claim can't be more than what Bangladesh would have taxed you on that foreign income anyway. And last, obviously, this is all for income that was actually generated outside of Bangladesh. So you've paid your foreign tax, you know you're eligible for a credit, what's next? Okay, now we're getting into the super practical stuff, how to actually claim it. And let me tell you, timing is everything.
I want you to remember this number, 2. You have exactly 2 years from the end of the relevant tax year to file your claim. That is a hard deadline, and if you miss it, you could miss out on getting that money back entirely. This just hammers home how important it is to keep good records. You've got to hang on to those foreign tax receipts and make sure you file that claim well inside that 2-year window. Don't leave money on the table just because of a deadline.
Okay, but what if you do everything by the book and your claim still gets denied? Don't worry. The system actually has a process for that, which is fantastic because it means you've always got a way to make your case.
And here is the second critical number to remember, 30. If your claim gets rejected, you have just 30 days from the moment you get that decision to file an appeal. This window is way shorter, so you have to move fast. The process itself is pretty clear. Your claim gets denied. You file an appeal within that 30-day window. Then your case goes to the Appellate Joint Commissioner, who takes a fresh look at everything and makes a decision.
What this really proves is that the whole system is built to be fair. Having this formal appeal process gives everyone confidence, because it's a guarantee that even if there's a disagreement, you have a clear path to get a second opinion.
So when you boil it all down, past all the forms and deadlines, the purpose is incredibly simple. This entire legal framework is here to make it easier for people and businesses to work across borders. It's about boosting economic growth by taking away a huge financial headache.
And that kind of leaves us with one final thought. We live in a world of remote work, digital nomads, and global everything. The very idea of where you earn your income is getting blurry. So how are these tax rules going to have to change to keep up with our super connected future? It's a pretty interesting question to think about.